Welcome back to part two of social insurance. Let's jump right in there. And I'll pick up where we left off. The Medicare financial crisis is where I kind of left off. So Medicare Part A, as I mentioned, is covered by payroll taxes. And obviously there's a huge deficit there for the next 75-year projection. We would have to substantially increase payroll taxes, and that to the point where it would be way beyond control, really dip into other people's cost of living and being able to fund themselves in the day-to-day. Again, fund is projected to be exhausted in the next 3 to 4 years, but again, that could be delayed or assisted by the government. So why is Medicare in such a poor financial condition? Well, obviously it costs more to get medical services today. They have a lot of ways to keep people alive and new medical procedures, and there's a lot of complexity in the medical services that are available. We're keeping people alive longer. The increased age of the population, they require more services and medical procedures. There's increased enrollments in Medicare. A lot of extra payments are made to private insurers for health care. And then prescription drugs are just outrageous. People are paying a lot of money to get on these wonder drugs to help their health, and they're actually hurting or impacting the Medicare costs for everyone overall. So this Medicare financial crisis, how are we going to handle it? Efforts to hold down costs have been, tried by reducing payments to hospital and physician. We're trying to cut everybody out of the profit, doing the best we can. But, what's happening is you have physicians that will no longer treat Medicare patients. You have limited physician options. Hospitals may have a financial crisis. We just recently heard about layoffs in the medical sector. So just cutting back on what profits are there for hospitals and doctors isn't going to solve the problem either. They could limit spending on certain services. So if it's not life-saving, they could say, okay, this isn't something we approve. That happens a lot. Anyway, there's a lot of new provisions in the Affordable Care Act that is trying to increase Medicare and make the system more efficient, but nothing's really proven that that's going to make a huge dent in it yet. Just something we all need to be aware of. Next major social insurance we want to talk about is unemployment. This is one that obviously most people don't really tap into very often. In fact, it's kind of a non-existent benefit that people don't think about very often. At least I don't. I know 2 months ago, prior to the crisis of COVID-19, you would see unemployment rates at the lowest they've ever been. Anywhere from 4%, which is next to zero, because you can never have true zero unemployment. There's always some percentage of the population that's not employable at any one time. But having unemployment insurance at the federal and state level really helps pay weekly benefits to those workers who are involuntarily unemployed, which can happen, as we're seeing with COVID-19 and the stay-at-home orders. So these cash benefits are paid out weekly. You can apply through your local employment agency, who's going to try to help you find a job. The basic objectives of unemployment insurance is to provide income during those periods of recession, help encourage employers to stabilize employment, so you don't just lay off people and then bring them back and lay them off. That happens a lot in the construction industry. They do seasonal work and they try to lay off people and then hire them back, or manufacturers, and they try to avoid that, keep it more stable. Unemployment benefits, overall through a recessionary period, should really help stabilize the economy, unless it's catastrophic like we're dealing with now. So most jobs in the private sector, some in the state and local, are covered by unemployment benefits. Private firms for sure are also subject to federal unemployment tax. State and local aren't always covered by both. So to be eligible for unemployment, you have to meet two monetary eligibility requirements. First, you have to have qualifying wages and employment during the base year that you're claiming unemployment. So, certain types of jobs, certain types of wages are qualifying and others are not. And usually it means that you have to be employed at least a certain amount of time over a period of the year, and you're paying at least a certain amount in per period. You also have to be ready and available and able to work. So, if you're sitting at home with an injury, you can't claim unemployment. You're in a period where you're not able to work, and you have to be ready to go to work if an option comes open. And actively seeking work is really important. So if you're claiming it, your local employment agency is going to make sure that you're going out if there's jobs available. Today's current crisis is completely different, and everything's frozen with the stay-at-home orders. So employers are not even allowed to be open. So it's a little bit different. It's one of those catastrophic events that really we can't show actively seeking work. So it'll be interesting. I think they're going to have to waive that in this emergency situation. And they also have to wait a 1 week period before you can start collecting. So if you're just unemployed for a few days, it's not going to be worth your while to apply because you're not going to be eligible. Actually, it helps cut down on some administrative expenses. So regular benefits that you get are based on your current past wages, like the last several weeks or months. You only get a percentage, so it's not like you're going to get a full whatever you would normally take home. You might get 2/3 or 50% of what you normally would. There's some formula. Each state has a different formula that bases your benefits on some fraction of your quarterly wages. The most you typically are eligible for is 26 weeks or half of a year. Under the extended benefits, you can get an additional 13 weeks added on during periods of higher unemployment where it's harder and harder to find a job, which we're dealing with now. And then extended benefits, if you exhaust all regular with high unemployment. So the government during major recessions like we're dealing with, Congress can enact emergency unemployment compensation to help fund it longer than normally would be eligible. So how is unemployment paid for? Programs are financed largely like payroll taxes that your employer pays for. You don't necessarily pay for it. And this is a little bit dated, but I'd say even if you were put in today's dollars, it's still a fairly stable percentage. It's probably 6%, but it might be closer to $10,000 of annual wages. So they're not paying it on all of what you normally would get paid. They're paying a certain percentage. And then for the most part, reserves have been pretty stable, but we've had really low unemployment for the last several years. So if you are an employer that lays people off all the time, so it says experience rating is also used. So if you have good employment records where you don't lay people off on a regular basis, you're going to get better tax rates than someone who lays off people on a regular basis because your employees are going to be collecting unemployment more often. So that plays into how much you pay in the insurance for unemployment. So what are the problems with the state unemployment compensation? Obviously, they're not going to cover all workers. So some people that don't fall under the state fund would not be able to collect because they're not paying into it. The state balances are definitely not adequate in periods like we're experiencing now. It is in a normal trend where maybe unemployment's up from 4% to 6%. But it's definitely not going to cover where we have such catastrophic events. I make mention of this. It's shocking to me, and some of you have probably seen the stats, but just last week they were talking about how 6.1 million additional people filed for unemployment in 1 week period, which is an unheard of high. The last high unemployment we've ever seen, the highest ever, was around 700,000 people filing. And that was in the Great Depression. Now, obviously, we have a different population, but even in 2008, nothing even remotely close to what we're seeing right now. Just so many people laid off, all these service industries that can't be open, all their doors are shut during this period of time. So hopefully we can get back to normal, but these will definitely be inadequate funds for this. A higher percentage of claimants that are out there are going to exhaust any regular state employment benefits that are available. Workers' compensation is another one. So that's the next social program. If you get hurt on the job, you are entitled to get coverage or compensation from your employer. But prior to the enactment of workers' compensation, that wasn't the case. It's a social insurance program that was put in place around the early 1900s. And it provides medical care for an employee working at hurt on the job, any cash benefits for any injury specifically to a body part, and it's going to give them rehabilitation services. If they die on the job, they'll get some kind of death benefit, their family will. So it has to be a job-related accident or disease. Let's say they're exposed to asbestos and that causes a lung disease, that would be covered if it's what they were encountering during their job. This also is an easy way to help reduce any economic uncertainty for someone who's disabled or hurt on the job, whether it's temporary or permanently, that they didn't plan on, especially if they're young. So under common law, we're talking about the early 1800s, if you were involved in an industrial accident or any manufacturing industry, and you were injured on the job, and the only way you could recover anything would be to sue your employer and prove that they were negligent before you could collect anything. So one, you'd have to have money to sue, which is pretty unlikely back in those days, to be able to hire an attorney to represent you. And you're probably not going to go after a big corporation. Today's world, you could definitely do that. There are attorneys that go after large because they get a larger percentage of it. But there were three other doctrines in there that actually really inhibited you from collecting money. The first being contributory negligence. So if your employer could show in any way that you contributed to your injury, like you were careless, you're klutzy, you caused it yourself by not doing something you should have in the process, then you wouldn't be able to collect damages, especially if a larger percentage was because of your own negligence or carelessness. If your coworker injured you, so they were doing something that wasn't safe, and you got damaged or injured as a result of those actions, you also couldn't collect. That fellow service doctrine would prevent you from collecting if your coworker was negligent in your injury. And the third would be assumption of risk. So let's say you worked in a high-risk job, which was probably the case back in these times where there was not a lot of safety mechanisms. Safety was not even important. You did a high-risk job, and you knew that, you would basically be accepting the risk of that job, so wouldn't be able to collect. So all these things combined would make it really difficult. In order to protect the common worker, the first employer liability laws were put into place late 1800s, early 1900s to actually improve the legal position of insured or injured workers, but they still had to sue their employer, which is really difficult to do. I think Wisconsin in 1911 was the first state to enact their own state work comp system, and by 1920, most states had their own workers' compensation law. And believe it or not, every state has their own workers' compensation law. They're all slightly different, very unique. That's a whole other class I teach just on workers' compensation, but there's a lot of details there. So coverage is based on the fundamental principle that when they established this, the employer and the employee gave up something and got something in return. So the fundamental principle with workers' comp is that there's liability without fault. So your employer, through vicarious liability, is always going to be responsible or liable for your injury related to work, whether it's your fault, their fault, or someone else's fault. If you're on the job, let's say you're in a car on your way to a job site and a negligent driver hits you, your employer needs to make sure that you're compensated. Now, they may go after a third party to help cover those expenses, but they still are responsible to pay you because you are injured on the job. So as an employee, by getting those additional benefits, you don't have to sue anymore. You don't have to prove fault. What you gave up would be that I don't have the right to go after and sue my employer. So you are giving up those extra rights. Unless it's an extremely negligent situation, then you might still have some rights. But for the most part, you can't just go sue your employer. If you accept workers' comp benefits, you can't go after them and sue them for more. There is a set amount that the state governs what you can get. Your employer, what did they gain? So they did limit their liability. It's not unlimited. They don't have to be subjected paying all the legal fees to go to court. They get to reduce that. They can move on and get people back to work. And it actually kind of reduces the tension between employee and employer. So again, but they also have to cover certain expenses. At least they know what they're getting into. So what were the objectives of state workers' compensation law? Basically to provide baseline coverage for all job-related accidents and diseases. It does provide substantial protection against loss of income. So if you get injured at the age of 35 and you plan to work to the age 65 and you are permanently disabled as a result of an injury at work, I mean, that's a huge amount of income that you're going to lose over the course of your earning career. Plus all the medical expenses. If you die, your family's left without any compensation if you didn't have life insurance. So all of these things add up, and this does provide substantial protection. It also gives you medical care as well as rehab. So let's say you did get hurt, but you can get rehabilitated not only physically, maybe you can get changed jobs, you can get retrained, you can get vocational rehab as well. And it actually encourages the employer to do things safely because they're going to have to pay for it. If you get injured on the job, they're going to end up paying for it either way. So if you're safe, they put, make you wear safety gear. They encourage safety. They can limit their expenses and actually save substantial amounts of money by doing that. And then they also reduce litigation. So employers, how do they comply with state law? They do have to show ability to pay for these injuries because they're liable. They can either buy a workers' compensation policy, so they pay a private insurer to cover any injuries that happen on the job. Again, if they're safer, they're going to get better rates. If they are large enough, they can self-insure. But in order to self-insure, you actually have to show that you have financial ability to pay. So that's going to be some kind of financial leverage, like maybe it's a bond that's placed in reserve to show that you have funding. And you actually have to be audited by the state work comp office as well. Or you could be part of a state monopoly or state fund that covers work comp. Almost all occupations are covered by work compensation law. The only exceptions are farm workers. It says domestic servants. I'd say domestic workers. So someone who works in your home, like maybe a housekeeper, a chef, whoever is working in your home, they could be considered an employee of yours, but you are not required to have workers' comp for them. And then any casual employee, if you hired the neighbor boy to cut your lawn every other week, they're just a casual employee, or someone who comes by and does a service for you once in a while, you would not have to have workers' comp on them. If you live in a state and you have a very, each state has a different rule, but with the state of Missouri, it's 5 employees or less. If you're a very, very small employer, you do not have to have work comp. However, it's not a good practice to not have workers' compensation. In fact, city utilities, any small employer that does business with us, we require them to have work comp, even if by law they're not mandated to have it. Why? Because if one of their employees is hurt on our work site, we would be liable for any of those injuries and damages. So there's 2 eligibility requirements to get workers' comp. One, you have to be one of those employees in a covered occupation. You can't be a farm worker or casual worker to claim it. And then the injury or disease has to arise out of the course of your employment. If it happened on the way to work, if it happened on the weekend, that would not cover you. A lot of people lie about that, but that's essentially what needs to happen, and sometimes they can prove that. So there are some different benefits. There's actually 4 benefits you get with work comp. The first is medical care, your hospital bills, your surgery, any labs, any medicines, anything that goes with getting you back to 100% wellness if it's possible. It's also going to pay you while you're hurt and at home, rehabilitating, possibly. If it's extended, it's different. But if you're off for a period of time, they're going to pay a certain percentage of your income. Usually it's about 2/3. So you're going to pay for that after a waiting period of 3 days. They're going to pay your weekly income, 2/3 of that. If you are permanently disabled, which we'll talk about in a minute, you never plan to recover, you're going to continue to receive disability income for the remainder of your life, if it's a job related. If you die on the job as a result of an injury, your survivors will get a death benefit. And then they also need, your employer needs to pay for any rehab services. So if you have to go to physical therapy or vocational rehab, all of those things to get you back to productive employment are important. Also, there's another payment that's not mentioned here. It's kind of morbid, but there's a meat chart that actually lays out every body part. So you have a pinky, you have a thumb, your right foot, your left arm. Each one has a value. So, if you lose a pinky, it's probably worth less, or a part of your pinky, a proportion of the total value of the entire finger is different than what a thumb would be, because it's harder to do certain functions without a thumb. So that's worth more money, but that is a one-time lump sum payment that you would get. And it's usually equivalent to a certain number of weeks. So the meat chart may say that your hand is worth 50 weeks of pay, or whatever it might be. That seems very low, but those are the kind of things that it would show on a meat chart. There are really 4 classifications of disability. You can be temporarily totally disabled, meaning you've had surgery, you're on your back, your doctor says you cannot work for a period of time, you are temporarily unavailable to work at all. You could be temporarily partial. Maybe you injured your arm, but your doctor said, well, you can come back for light duty, so you can still do work for a period of time. Then after your arm heals and you go through rehab, you'll be back to normal, back to your old job. That's a temporary partial. You also have a permanent partial. Maybe you lose complete use of one of your arms or extremities for forever, but you still can do other gainful employment, just a different type of job or different rules. And then there's permanent total. This is where you cannot be employed in any capacity. You can't be retrained. You're not able to work at all forever, at least for the near future. So those are all different levels and varying amounts that you would get paid depending on the severity. So there are some problems with the state workers' comp. Obviously, rising medical costs really impact this. If you have to have lots of surgery, especially back surgeries, those are very expensive. There's a lot of fraud and abuse. People have the tendency to turn in a work comp injury or say they got hurt on the job, but then they're out like skydiving on the weekend and they get caught. That's why a lot of employers hire undercover agents to go find this. And so does the state or the federal government with regard to disabilities for federal government. One thing I will point out that if you're collecting disability from the federal government for Social Security, that means it's happened when you're not at work. You can only collect one or the other. You can't collect both. So if you got hurt on the job, it would be workers' comp, and you're disabled as the result of that. If you were not gainfully employed and you're collecting disability, that would be through the government. That is unrelated to work injuries. And so the other impact would be aging workforce, meaning that people are working longer. Older people have a tendency to have more accidents or get hurt easier. So those also have an impact on the rising cost of workers' compensation. And with that, that's all I have for social insurance part 2. I hope you have a good evening, and I'll talk to you soon.